Andy Fenton.
Sir, how are you?
I'm well, brother. I'm well. Good to see your smiley face here today while everything's warming up. Facebook Live and the afternoon conversation is about to occur. We should do some quick intros, I suppose. Make sure we let everyone know what we're up to. For those joining us for the first time, welcome. For those coming back, you guys know the drill. Andy and I, from our respective industries and professions, property and finance / the share market, the share world, banking. We've been chatting with our respective tribes, our communities over the last year, over the last 12 months, helping out, hoping to add some sanity to the world of media when it comes to investing, try to make some sense. We get together. Used to be a Friday, but now it's a Wednesday. We used to drink wine, but mostly these days we drink water. Hence, wealth, wine, and wisdom.
It's it's water, wealth, water, and wisdom at the moment. Probably.
Wealth, water, and wisdom. Yeah, well, there you go. It's with the W's, so we're happy with that. But folks, welcome along. Fabulous to have everyone dialing in to the live Wealth, Wine, and Wisdom today. Should be a good conversation. Plenty of things going on out there in the marketplace. Plenty of tidbits to talk through. And usually what we do in the show is we have 3 sections of the show. And they are as follows. What's in the news? Andy and I will talk about some things that are going down or something that's popular out there that, we should all be aware of from our industries. Things you should know. A little bit of a moment for teaching. And sometimes there's a few lessons that we'd love to share a little bit at a time, just to build the knowledge base for you, depending on where you're coming from. And also questions. We'll do some questions at the end, or probably partway through anyway, as we go along, and have a bit of a chat about what is going on. So those are the 3 things we get up to each week, and also the idea that Andy and I might spot a few things along the way that we might offer our opinions on when it comes to our effective industries as we go. But Andy, anything else to add? What we've got coming up in what's in the news, but how's things in your neck of the woods, my friend?
Mate, it's been good. It's been interesting. I'll tell you about the day in a sec. But for those of you who are watching, any questions that you've had since our last session? Last time we did talk a little bit about inflation. We did talk about interest rates and obviously property market shares and all of those sorts of things. So if you've got the questions, start to compile them now. If we can get you on, we might get you on. If we can't, we'll answer them from the chat box. So Riley, good to have you on board, and Alison.
There's Alison.
Our usuals. Good to see you there. For many of you, you'll notice
rolling along. And there's Riley. He's always online supporting as well. So good to have you guys here. Give us a shout out in the chat where you're dialing in from, team, gang. As we go, let us know.
And mate, you might well notice this has probably been the best dressed I've ever been on Wine and Wisdom. I ventured out into the busy city, into the CBD, and got some things to report on, all things commercial property, actually, which is, as you know, one of my darlings at the moment, and one of the areas that we're doing a lot of research, and we're doing a fair bit of investing in those sorts of areas as well. So, going to share with you some insights for some incredible minds that I listened to today. The biggest bugger, and it's kind of ironic actually talking about vacancy rates of commercial property and the remobilisation of the economy and the cities in and around Australia. So some great stuff to share from that. But you know what, mate? I think probably one of the most dangerous things about the remobilisation of our capital cities is actually the kind of damage that leather shoes do to your feet. I haven't worn leather shoes for about a year and a half, and I reckon I've got a little blister that's formed on a well-worn pair of leather shoes. I think my feet have become pretty soft. but that's from pounding the pavements of Melbourne today. So I got to share a little bit of that with you. But got a little bit of stuff from in the news as well, which if you like, we'll jump into straight away.
All right, Andy Fenton, what's in the news? Well, I'll try this, a little bit of special sound effects today. I can't hear that, but I know it's happening. There's the drum roll. Andy Fenton, what's in the news? Let's have a bit of a look at that.
Right. So
what's in the news?
As per usual, let's lead off with one of our favourites, the good old Apple Brigade. Apple has officially become the most profitable company in the world. Actually took over from a petroleum-based company out of the Saudi Arabia, I'm pretty sure, I think it is. But after oil prices fell a little bit because of the pandemic, Apple maintained pretty significant margins over 2020, while people bought up iPhones, Macs, iPads, pretty much exactly what we were talking about as you and I were frantically buying our equipment to stream. Apple was one of the big winners from this market. So not only did it hit its $1 trillion cap and soar straight through it, it has become the world's most profitable company.
$1 trillion cap. That's insane. That's so much dough. Like, it's just amazing, isn't it? And whoa.
more zeros than what most of us know how to actually calculate. But so it reported net income of 59 billion. That's billion with a B, Jason.
Wow.
So that's our old man here. $59 billion is their reported revenue. So, mate, they're absolutely crushing it. But if we have a look over the other side here, you'll see our old mate Mr. Buffett has actually cut Apple stocks, and I thought this is an interesting kind of dovetail in, because they've reported to be the most profitable company. Of course, tech stocks have risen very, very sharply over the pandemic and have driven the US market to a large degree. But you're going to start to see headlines like this around, because the media love to paint the bad side of it. And so let me just give you some insights into these comments here. Buffett cuts Apple, and Barron trimmed Tesla, and they're one of the biggest advocates of Tesla and have been for quite some time. But here's the thing: so you look at that and you go, oh, we've got to sell Apple, we've got to sell Tesla. Well, the reality is that these companies have massive portfolios of stocks, and when something like Tesla did 500% over the last 12 months, that stock becomes a very large part of a diversified portfolio. Yeah. So these guys then have to sell down large positions within those stocks, one, to de-risk the portfolio, but also there's a common thing called not falling in love with a stock as an investor. It's one of the biggest mistakes you can make, is that you fall in love with a position, you never sell it, and as we know, things go up and down over time, and you can erase the gains that you've made. So when you see a headline,
you're saying, Andy, they're taking some profit off the table. They're putting it. They're taking some profit while they can, and then they'd redeploy it somewhere else. Smart maneuver, good investment strategy. Yeah, certainly in the stock market. Yeah.
But my sort of point here is that when you read these headlines, then they do spark sell-offs, right? Because people said, oh, it's the time to get out. But the reason why they're getting out is predominantly risk management. Look, I'm assuming, right, because I don't have a direct line with either of them. But if you do want to call Warren, just whack your phone number in our little chat box, and I'll give you a buzz. That goes for both of you. But ultimately, when people see these headlines, they go, okay, the story's over, the roller coaster is about to begin. And it's not necessarily the case. As we've seen in the bottom right corner, Apple's still the world's most profitable company, become the world's most profitable company. And even though tech valuations, so that the stock valuations, the price would be very, very high at the moment, or is very, very high. If you believe that Apple is going to continue that growth, then there's probably going to be some volatility, but 5 years from now, likely to be significantly north. But just to contextualize these headlines, because they are sensationalist, because people read this and they go, oh, Tesla's on the way down, Apple's on the way down. But a bit of the story behind it is that these guys are taking profit and managing some of their risk. So definitely doesn't mean that story's over. At the moment, we are seeing some tension in and around the tech stock area, and that we spoke about last week, because inflation and bond yields are supposedly rising and they're back down again. As I said last week, they'll be up and down like yo-yos as we speculate. But anyway, just wanted to put some context around there and give Apple a big cheers for taking the first $1 trillion market cap and then becoming the most profitable.
Yeah. Go. Give him a hand. Oh, is that?
Everyone's laughing at them, Jace. They're laughing at them.
Hold on. How about that? That's the drum roll. Oh, no. I've got the wrong one.
I feel like I'm on a bad episode of Red Faces. And then this is probably more topical for business owners around and what we're going to start to see more and more headlines in and around. But 4 days until JobKeeper is axed in the form that it exists, which is interesting. And mate, we can chat long or short about this, but it's going to have an impact. What impact it's going to have is yet to be seen. I was in a presentation today where they talked about job statistics out in Australia, which are phenomenally high at the moment. And one may assert that one of the reasons why they're still significantly high is because there are a lot of zombie companies or companies that are being propped up by JobKeeper. So the expectation is that we're going to see significant companies go into potential bankruptcy and the like over the next a few months. We won't see a lot of that because we're not going to actually see the trail of those events for some time as far as getting the information, because winding up takes some time. The courts are backed up. There's a whole lot of inertia that needs to be overcome, but this is going to have a flow-on effect. So Australia has been waiting for this to happen. If you have a look at markets have been sort of up and down a little bit recently in Australia, and one might believe that this is one of the key things that is assisting that, because it's uncertain what's going to happen, and as soon as there's uncertainty, uncertainty hurts markets to a large degree. So it'll be really interesting to see how this plays out, and a nice book end or a big book beginning as far as the new budget's concerned, because the new budget's not too far away, and we're proposing or believe that there's going to be some sort of support that's going to be coming out. There's definitely going to be support that's going to be coming out in the budget. Just depends on what form. So stay tuned for this, because this is going to be a very, very interesting statistic that will also impact on our inflation. And as we spoke about last week, and if you want me to chat more about it, we can. But ultimately, one of the things that I mentioned last week is, yes, we're getting a supply push inflation, where the lack of supply through global chains or just distribution, things aren't getting to places because they can't. That's pushing the cost of goods up, because same people want the product, but the product can't get to shore. So what is on shore is getting the price of lifting up. So that inflation in some degree is synthetic and will normalize as supply chains normalize. So meaning the ships can actually dock and distribute the goods without COVID getting in the way. But one of the things that they just actually, Jay, so the Fed came out with commentary. I should bring it on because it mirrored exactly what we were saying last week. Is that they're not too fussed about long-term bond yields, and they're not too fussed about inflation at the moment. And it's not because that's one of their main triggers, inflation, that they're meant to worry about and potentially raise interest rates. But they're looking at the real job numbers and the real job statistics. And at the moment, they believe that, there's a lot to play out in that space. And I think that there's going to be a lot that's going to play out here in Australia. Don't know exactly where it's going to go, but it's certainly going to have an impact.
Well, we certainly see that in the property world. There's a lot of money in the marketplace, like lots of cash. And for the first time in a long time, the millennials are cashed up. They're cashed up. It's cheap enough to purchase from a cash flow point of view, a ratio of their incomes to serviceability, not property price, but serviceability, because those interest rates are so low. And many of them, Andy, have taken 10 grand out of their super or 20 grand out of their super. They've banked it. They've put it in their bank account. They've been on JobKeeper. They've got extra cash. Well, the level of saving in Australia has increased significantly, and it actually happened. The behaviour was really interesting, Andy. On this one, was the same in after the GFC. The GFC saw Australians have a higher level of cash savings in their bank accounts, and now we're seeing that after COVID as well. So it's not a bad behaviour. It's pretty good behaviour. Sounds like Aussies park a little bit of cash potentially when the tough times are around, just in case. So, it'd be interesting to see how that JobKeeper plays out. What I do know is there's some incentives going around. There's some incentives for the aviation industry and tourism, and I think what we're going to see, and the government's already talking about it, is it flow into those industries to create jobs rather than flow to the individual, to bank the money. So, JobKeeper stopped people losing their jobs, but this next section will be directly aimed at the industries to create jobs or keep the job from the industry point of view. So it'd be interesting. It'd be very interesting. You're dead right.
And look, I know it's terrible to be within the companies that are suffering, but it's more devastating to prop up companies that are never going to get anywhere long term, because ultimately you're backing a horse with three legs, and it's only a matter of time until that's just not going to run anymore. And unfortunately for those businesses, they're called zombie businesses, which for those of you who don't know what zombie businesses are, they're businesses that are effectively bankrupt or cannot operate and will not be profitable after JobKeeper is taken out. And there are companies out there that are literally just banking the JobKeeper. So they're an administrator for welfare, but they're almost misappropriating some of those funds in other areas. And ultimately, as soon as JobKeeper goes, the company won't exist. And there's quite a number of them, and the statistics are quite staggering. But to your point about cash, Jace, there's never been more cash in bank accounts, in venture capitalist funds, in share market funds. There's never been more cash in the system than what there is right now. And I think next week I might bring in some statistics around it. But just to talk to your point about retail, when we have a look, and this is a slide that talks to top online shopping weeks ranked from 1 to 5. As you can see, after Black Friday, we've absolutely had a gangbusters trend, and it's been going up for over a year, for over 12 months. But look at those statistics. So the grey line there is last year, is 2019, and the red line there is 2020. So
well, it's interesting, isn't it? That right now I've purchased more things online in the last 12 months than I had done probably in the previous 47 other years of my life. So it's so true, Andy. Like that, it's going to be fantastic to see this play out. I'm actually a big fan of it personally. I feel old world inefficiencies and bad habits and wastage. Human wastage, human time, human focus, human resources. I think there's a big rearrangement happening, and I'm actually quite excited. Personally, my personal life, my business life has been rearranged significantly, and I feel for the better. And I think maybe a lot of the world will too. We've got a few people here right now. Jeff's giving us a shout out. Jeff, how are you, mate? Good to see you. Craig's online. Thanks for joining, Craig. And whoever that is, for some reason, sometimes the chat function doesn't pick your name up. But yeah, we've all been purchasing, that's for sure, as we've gone along. So it's an interesting one.
If you just have a look at this section here, this one might assert from this statistic, this says here, pubs closed, restaurants takeaway only. So as soon as we could stop drinking and eating, we just started buying aggressively. And that may or may not have been the trend, but that's it. And I'm going to chat later on about how this is actually, this phenomenon that we've got here, how this is actually potentially really going to change the way that we consume, the way that we live, the investments that we look for, and potentially the businesses that we're in, because it really is going to have a profound impact. And in my belief, that sort of consumer behavior is going to be here to stay.
Yeah, mate, love it. So we've got a few people online. Just a quick shout out for anyone. If you have any questions, any thoughts, anything that you want Andy and I to talk about, chuck it in the chat. We'll have a bit of a time, probably in about 15 odd minutes, where we'll talk about and answer anyone's questions. If you've got anything that you'd like us to chat about, then put it in the chat, and we'll have a bit of a yarn about that one. So yeah, no, Andy, interesting times out there. Well, on my side of the fence, there's a lot happening. Also, if we have a little look at the marketplace of the world of real estate, have a look at these headlines going on right now. Melbourne's prestige housing market firing on all cylinders. Record prices, $30 million mansion in Toorak.
Wow.
Penthouse becomes the most expensive flat ever in Australia, $20 million in Bondi just now, right? Imagine that. Imagine buying a unit for $20 million in Bondi. Well, people are doing it, Andy. That's what's going on. It's happening right now under our noses in the real estate market.
You wonder what that would actually do to the footprint, right? So if you say that there's 10 units in that, and that's $20 million, so that's $200 million per probably square meter of actual land mass underneath it. That's incredible.
Yeah. And here's one to all those people who say, "Oh, units don't go up." Rubbish. I wouldn't mind buying that unit that gets valued at $20 million. That'd be all right. Andy, what do you think? Huh?
Yeah. Geez, I wonder what it costs to buy before that. Or is that a newbie? Is that a newbie, or is that a second sale?
It'd be good to find that out. Actually, it'd be interesting to know. I could probably track that down on RP data.
That's outstanding. Jeepers creepers. Nice view though.
Beautiful view, and certainly one of those destination locations. When we talk about real estate, destination location from all around the world. People worldwide know about Bondi, right? And so there are some destination purchasing locations that people pay more than they should because they want to live there. One of those other ones is Byron as well. Byron Bay, partway through COVID, you and I talked about it in one of the Wealth, Wine and Wisdoms. Record prices set down there, $20+ million for a house on a nice bit of dirt down Byron Way as well. So very interesting. There is a lot of money in the marketplace right now, and a lot of pressure and demand in the marketplace. And one of the things the other day, I did a bit of a Facebook Live on it, and someone said, well, where are all these people coming from? Because hasn't immigration, been stopped? Hasn't it gone down? And the answer is yes. There was only a net, I think, 21,000, not $21,000, but 21,000 people, 21,000 people enter the country in comparison to an average like 250,000 new immigrants or new Australians in the past, on average decade. What everyone hasn't realised, Andy, is that
do you know that's less people that have come back into the country than actually moved from Victoria to Queensland during the pandemic?
No. Here's the thing. These are new people, right? New Australians. Guess how many Australians moved home? 600,000 Aussies returned back to Australia from other places in the world. And that has put a severe amount of pressure and money back into certain economies. And we're seeing that play out. And it's quite an interesting thing to sort of get our noodles around. At the same time, supply chains are absolutely broken and stuffed when it comes to residential real estate. The interest rates are the lowest it's ever been. It's unlocked literally 10 years of people who haven't been able to buy their first home, the millennials, these low interest rates have unlocked, like literally hundreds and hundreds of thousands of millennials out of the renting cycle right now. And in every capital city of Australia, it is pretty well cheaper to buy than it is to rent. And plus then the government has thrown billions of dollars at the first home buyer scheme, or not the first home buyer, but the owner occupier boost scheme, $25,000 for that owner occupier. And that has really accelerated things to no end. And I spoke about it last week. Right now, we're seeing that fake inflation happen because these things are being restricted right now, and that fake inflation is flowing into property prices at the moment. So I think what we say often is it's an interesting time. Isn't it interesting to be in this marketplace right now? As we go.
As all of our expats say, there's no place like home. 600,000 came back and started consuming real estate. But mate, it's interesting, and we've got the same thing happening in the commercial world at the moment, the commercial property world, to a degree, not to the same level. But you weigh it up and you start going, well, prices are astronomical. They're going up aggressively. Is it bubble territory? And we get in the stock market all the time. It's a new bubble every time it goes up, and the bubbles burst every time there's a correction, and then it goes back up again. But it is that period of time where it's risk on, right? And you got to take risks to go into the market. And yes, it would have been great to get in yesterday, but investing's easy in hindsight. It's one of the easiest
Andy,
games
investing easy if they would have been listening to you and me at Wealth, Wine and Wisdom. Hey, we were telling everyone this is the best time I've ever seen to buy real estate. Get in before you miss out. But anyway, there's that I told you so moment.
it's one of those things that's really, really difficult as it is in the stock market at the moment. It's really difficult to see through it, because you go, this is higher than it's ever been. It's higher based on, per wage. Well, not quite. Some of those statistics are kind of level, but it feels high, right? But then when you start laying up the facts, right, behind it, so interest rates low, likely to be low for a while. Yes, inflation's going to happen, but it's going to take a little while for that to have any major impact. Meanwhile, 600,000 people came back. We still don't have borders open. Migration coming, land shortages. Like when you look at the actual fundamentals behind it, the fundamentals go, there's still a lot to play out, but there's the emotion that kind of goes, oh God, it's already run a bit. Like, have I missed the run?
Yeah. Well, for me, my call is there's going to be significant pushes along in the property market for at least 18 months to 2 years. It's just ahead of steam right now. And certainly the supply chain, I've chatted to, you before, and any listening in, the supply chain takes 3 to 5 years to change in the Australian residential delivery system. And right now, we just don't have enough ability to finance and build enough properties for the demand at the moment. And that demand will continue to build for a while. And those who have got,
right. When there's a shortage, we know what happens. Just look at toilet paper. It didn't go up in price, but there were people selling it on eBay, and I think that the powers that be were trying to stop it. But that's the reality, really. When you look at the basics of demand supply, if there's too much demand and there's not enough supply, it is going to push the cost of things north, and that's where it's a really interesting time. I think commercial, not quite yet, but it's got the signs of that. Certainly the stock market is showing signs of that, and certainly the resi market here in Australia. And mate, it's an interesting story, but you kind of think, wow, it's gone, but it's like there's potentially still statistically a hell of a lot to play out.
Yeah, I think there is a lot to go, and I've chatted to everyone about this one, and we could probably talk a little bit about in things you should know a bit later, how to lock your equity in. Just like what was reminded me a moment ago when you were talking about the grandfather of investing, Warren Buffett, taking some profits off the table. Profits off the table. Well, in property world or in the real estate world, taking some risk out of the property is about locking in your equity as the value of that property increases. Certainly for investors, certainly for those who want access to their capital as we go along. But I think there's still a little bit of room to go. There's a lot of rhetoric around 20 to 30% increases over the next 12, 18 months, 2 years. Listen, I think that's pretty conservative. We saw that coming a long while ago, but just don't underestimate this, folks. Not every property will go up 20, 30%. That is not going to occur. Some properties are rubbish. They'll always be rubbish. And, they might go up a bit, but afterwards you'll regret owning them. So be cognizant of how and what you go ahead and buy if you're in the market. And, places like Perth, which has had a 10-year decline in real estate activity and confidence over there, are absolutely going, like, the supply chain over there is absolutely cactus, and it's insane what's going on in that marketplace right now. So, just because something's not happening in your backyard, sometimes if you look over the fence into different states or different cities, there's a lot going on. And certainly Southeast Queensland is receiving a huge amount of people into that land mass, and that's really accelerating prices as well. So it's going to be interesting to see as we go along. But this is the one that I might sort of roll from what's in the news, Andy, to things you should know when it comes to.
We're going to talk interest rates, aren't we?
Well, yeah, I think we are, because it was interesting. Everyone's talking about, all right, well, something's got to happen. And I mentioned it last week. I mentioned it, was it last week or the week before, about, Philip Lowy, the governor, said, yeah, listen, we think we're going to have to do something. But what he did say, Andy, and this is an interesting one, I'm not going to put up interest rates anytime soon. So, yeah, well, and
but my mates,
they've always been honest, right? Yeah. But what we can learn from our cousins, our Anzac neighbours, I said last week, he said he's not going to put up the interest rates. But what might happen is loan to value ratios, they might reduce the ability for investors to borrow, let's say at 90%. They might reduce it to 80 or even 70%. Or in New Zealand, what they've done is they've only allowed you to unlock 60% of any equity in a property, and so on. So if it gets to there, we all must, like we do, Andy, understand what risk going forward. Because to be honest, you and I both know the risk of the market, ups and downs in the market, that's quite normal. But the risk of irrational, brain-dead politicians making stupid decisions is actually one of the bigger risks that we face when we take positions, right? And they can change rules which affect us. And if we don't think about that as we go as a property investor, that's where we can get caught, technically with our pants down and not know how to do that one. So what I'm saying to people now is the thing you should know: as your properties grow in value, the equity locking in your equity is going to be more vital than ever before. So if the government changes their mind, APRA comes back in and changes some things, whatever it might be, you'll still have access to your capital. If you require access to your capital to grow your portfolio, to grow or diversify your portfolio, whatever that might look like. So that's something that I believe everyone should be taking heed of as we go along. And our first bank did something interesting, and this is where we could probably chat, Andy, I think, with the things we should know about interest rates. So the Commonwealth Bank put up their 4-year interest rate, their 4-year fixed interest rate. The CommBank put the 4-year fixed interest rate up. but they dropped their 2-year and 1-year fixed interest rate, right? So what does that mean when it comes to economics? What probably it's more in your camp, this long-term decision-making rather than my camp. The bank is saying, all right, well, we want to hedge some costs. We want to hedge some risk. What would you say to that one, Andy, for people listening in about what they should know about that type of behavior and thing from the bank?
Look, normally I would say standard economics would assert that if the banks have got higher longer-term interest rates than their short-term interest rates, it means that they have an expectation that rates are going to be higher in the future. So an example would be if you've got 1-year rates very, very low, and then you've got 2-year rates a little bit higher, and then 4-year rates significantly higher, you would assert that the bank's economic position is that interest rates are going to rise quite dramatically over the next 4 years. And so what I mean by that is the cost of money to the bank. There's a big but here, though, is that I'm not 100% sure that that is their true view. Now, I haven't done enough research, so I'm just going to throw out some opinions. So I haven't done the research. This is speculation. It's not fact. It's total speculation. But at the moment, my feel is that we might see this more as a profit exercise under the guise of longer-term interest rates rising, right? Because
Andy, they wouldn't do that, would they? Gee, they've never done that before, have they?
But here's the thing, right? Because CommBank has done it. Now it's illegal for them to collude, but they seem to mirror everything that they do. So what ends up happening? They've got market dominance at the moment, as they always have, right? So if they raise their long-term rates, well, other banks have then the competitive advantage to keep theirs lower, get more attention into those rates, so that there is an efficient market that keeps them, I guess, straight as they could possibly be. But my belief, my completely unfounded belief on this at the moment, and I'll do some research and I'll come back to you next week or the week after. But my belief is that the banks are actually going to start to play around with this and just see whether the others follow. Because I don't believe that the banks think that, in 3 years' time, interest rates are going to be significantly higher than where they are right now. Maybe they do, but that's not the views that I've been hearing coming out from their economists, at least not yet, or not within the last couple of months. Now, they may change their story so it matches up with their interest rate that helps their profit. But I think that this will be one to watch. I reckon there might be a bit of movement in that medium to longer term fixed rate market.
Yeah. Well, mate, that's it from me. What's in the news you should know. What about you? Have you got anything to share with everyone today? A few people on still right now, and we've got a few questions here. So
I love Luke's question. We'll jump to that in a tick. Mate, I have something interesting from the presentation that I was at today. And so it was with one of our major commercial property partners that we do a lot of investing with today. And they had some of their research companies come in today, which was magnificent. Got a wealth full of knowledge, complete third party. It was JLL and CBRE. And they had a supply chain expert come in. So not necessarily property. And for those people who don't know what supply chain is, and quite funnily, as we were chatting at the back of the room beforehand, she's gone, up until now, nobody actually knew what my job was. And now everybody's going, supply chain. But this is really interesting. And this is speculative, but there's some facts behind it. But so supply chain is effectively, like simplified, it is the cost of getting a good from point A to the consumer's pocket, right? And so typically, as we go through that, it starts off, it gets manufactured, then it gets shipped. But between the ship, there's some sort of transport, right? Then it gets shipped. Then it goes onto a big truck. Then it goes onto a smaller truck. Then it goes onto an even smaller van, and then it delivers to your door. It used to be that. Well, actually, it's been pretty efficient in Australia. It really has. It's only when you post Christmas cards that you don't get them. So if we think about consumerism at the moment, and one of my favorite things, as you know, Jace, has been logistical industrial property. And
Yes.
it's been a big focus of mine for a while now. One of the things that I think is going to really shape the way that we live moving forward has a lot to do with this supply chain stuff. And I haven't been able to articulate it to now, but here's a really interesting, well, I find it interesting, slide from today's chat. So the supply chain cost profile. So this is effectively how transport costs can influence locations and decisions. So people always assume that rent is one of the biggest costs for companies, right? But what we can actually see down here is that it actually only makes up a very, very small portion of a business
operation. Can you zoom in a bit, Andy, on it for us? Oh, yeah.
Right. Only makes up a very, very small portion of it. But the transport, the logistics side of the equation, the transportation is actually 50%. Now, in some of the conversations I was having today with the advent of Amazon, which apparently we feel like it's mature, but it's very immature in Australia right now. Right? It's growing, but it's very, very immature out here. And talking about how Amazon it's actually this supply chain demographic, or this supply chain situation has companies actually selling things for negative profit because the costs of the logistics, or because the cost of the supply chain, because companies have had to very quickly go from retail store to delivery, and they don't know their numbers well enough, and they don't understand this dynamic. But the supply chain, 50%, right, is in the logistics. And here's the really, really interesting part, which is, I think, going to be great business opportunity moving forward for anybody who's looking at, businesses to start up. Don't do it based on this. Do your research first. But 28% of that 50%, so let's, a significant portion, is the cost of the last mile. And what the last mile is, and I'm going to get to how this is going to operate with property and so on and so forth. The last mile is the name that they give, quite interestingly enough and quite cleverly. It's the last few miles of the delivery, because many things go into a ship, potentially billions of dollars worth of merchandise might go onto a ship, or hundreds of millions of dollars. And the cost of that transport is proportioned across all of those different suppliers. Then it gets onto a truck, which has not maybe hundreds of millions, but maybe millions of dollars worth of stock that sits in the truck, or hundreds of thousands of dollars that sits in the truck. Again, that's amortized across the goods in the truck. That once it goes past our parcel post and goes from a distribution center, then it's in the small van, and that is the highest cost of the delivery, the person who actually brings it to your door. Right. And when you think about it,
I'm amazed that Uber isn't in there on that one, Andy.
Mate, this is the thing. Like, I honestly think that there's going to be some major changes in this area. We'll end up with suburban-based pop-up delivery centres, right? Because they'll compete with Australia Post, maybe offer a better delivery. Maybe there's amalgamations, maybe whatever the case may be, because that will become, it's a significant cost to the business, right? It's a 1/8 of the total cost of the supply chain, right? And it is the most expensive part. So that there's a potential great business opportunity in this sector. But if we then start to look at it and we go, okay, well, let's zoom out and start to think about this, conceptually based on how we consume. And next week I'll bring all the statistics, which are just mind-blowing on our consumerism, completely mind-blowing. But it's growing and it's not going anywhere. It's here to stay. I consider that to be fact. Everyone gets everything delivered these days.
I love it. I'm enjoying it. I don't.
You'll end up with the children being delivered. I don't know. They'll probably, they get delivered anyway. School buses, don't they? But my point being is this is growing exponentially, and so the logistical operations, we may well see that, Mornington's industrial area becomes a logistical centre, and then businesses around those hubs then become very core businesses to the logistical operations that are supported, because they need maybe a few smaller trucks to enter our smaller area in order for then smaller vans to be able to disperse, right? Because we can't have massive semi-trailers coming into the suburban areas. It just doesn't work. Yeah. Which then and this is an interesting fact that I learned today, is that Amazon over in the US, and it's very different over in the US, Amazon locations, these logistical hubs that they're getting on the outskirts, and this goes back to what we were talking about, 12 months ago, when we were talking about those logistical properties. They are buying these places, but then you would think, that might devalue it because it goes from sort of quasi-residential to industrial. These prices shot up because then everybody wanted to be in and around next to Amazon supporting the logistical hubs, because they're not just robotic warehouses, they're actually lifestyle places for lifestyle participants with Amazon. Everybody wants to work for Amazon. So and I know I'm drawing some large bows here, but when you start to think this consumer behavior is here to stay and is only going to escalate and rapidly escalate, then you're going to have more of this supply chain coming in, more people trying to figure out how this works, and you're going to have more of these logistical hubs in and around the greater outskirts of our areas so that things can be delivered at a substantial cost discount, because that last mile, 28%, is a significant slice of the pie, and figuring out how to bring that cost down. And of course, Jace, being in real estate, if you buy in a good area, then the chances are that's going to go up in value over time. Then ultimately you're not just buying an expensive location. And if we go into here, we can see that the cost of the location is one of the lowest parts of the logistical operation. Then it's not too hard to imagine that we're going to have these, quasi small little logistical hubs in and around our localized area, serving our area, creating jobs for the local area and creating business opportunity. So I think it's an incredibly interesting. Obviously, it's still very young and juvenile, but Amazon's here. They do have more competition here than anywhere else in the world because they've got Kogan, they've got Catch, but they've got, I think it's a wild amount, over 50%. It could be even as high as 80, I'm not sure, but I know it's definitely above 50% of the US market, which is crazy. Yeah. But out here in Australia, there's a lot more competition. So whoever can master that 28 is going to be at a real advantage. And maybe it's not one player, maybe it's a combined affair, but really, really interesting, because then I think, well, if you want to be in a good location from a resi real estate perspective, you'll want to be close to one of these logistical hubs at a point in time. So your deliveries come same day. So your stuff gets there same day. So my for the future is that I reckon that when these places land, they'll actually increase the value of real estate, maybe not instantaneously, but over time, because of the proximity for people to be able to get what they want.
Well, it's an age-old foundational part of the growth story when it comes to real estate, proximity to infrastructure, Andy. The infrastructure is just changing, right? So what we're seeing right now, certainly buildings, offices, homes, apartments, if they don't have access to good internet, they're worth less in rent. And ultimately probably worth less into the future if you can't get internet there. Maybe there's a two ends of the extreme where you don't want the internet, and then when you do,
yeah, that's right.
But it's an interesting one. Certainly, the things that you want to have proximity to potentially are going to change and be more important for different reasons. You're dead right. That's it. Listen, I'm going to show a quick comment, and this is the classic stuff that we're talking about, when it comes to governments making decisions right now. In New Zealand, the government has removed the policy, removing the tax deductions of interest from property investors, effective at 27th of March. So there you go. Thanks, David, for sharing, mate. Fabulous. That is the thing that we're talking about when it comes to government risk and exposure, when these policymakers, at the end of the day, it's insanely brain dead that unless the New Zealand government's going to underwrite the cost of funding and put up a whole $1 trillion funding scheme for developers in New Zealand to build buildings without pre-sales, right? Then that's going to fail. That's doomed. That is doomed right there. I'm going live and I'm saying it live. That is doomed because that is just one part of the mechanism in a massive functional process that they haven't even considered. And at the end of the day, funding's the issue. It's interesting. I went to China, and in China, you don't need any off-the-plan sales. The buyer puts down a 30% deposit, and they release it to you as the developer, and you use the deposit to fund the construction of the building, and the bank and the government guarantee the funding to complete the construction. Now that's smart. That's smart, right? That's like, so, you know, if you want a supply chain, stop being stupid. I could go on a rant there, but anyway, I won't.
It's a common question I'm asking when we're chatting with a lot of our investment teams and economists, and it's becoming more and more prolific, the question around it, which is, look, we've talked about it again for a long time, but just in a different form. We talk about Kerry Packer, but you know, the one of the key risks that we see and that we're starting to rank very highly, whether we're looking at industrial, whether we're looking at commercial, whether we're looking at infrastructure assets, is the political risk that's associated with it, because they do have the capacity to come in and really balls things up, and over extending their hand at times is something that they've been historically very, very good at overextending the hand at times. And you know, it's a hard decision to make, and so I won't completely crush the politicians out there, but it's hard to factor in all of the various different things that they need to weigh up at a single point in time. But the decisions are made far faster than what they should be, quite a lot, because they're made based on something that's happening and there's pressure to change it. And if you make decisions that big quickly, then there's a very small chance that you're going to get it right. And I think that we'll see them start to intervene. And I think somebody asked whether they will. I think it's almost a given.
Luke said, Luke said, do you think the governments will intervene? And
to what extent, where and how, we don't know, but they will start making noises about it before they do it, because they're going to want to make sure that by doing it, they're not going to absolutely blow up their popularity, because at the end of the day, it is a popularity game.
You took the words right out of my mouth. It's a popularity contest, Andy, and this is the thing. This stuff is not, unfortunately, sadly, we could get into politics, and my opinion would be that we should be voting parties in for 10 years and giving them a chance to actually do something significant, not bloody, 4 years where they can't even scratch themselves. But, we'd
probably still have 8 different PMs.
I'd probably be unpopular with that discussion. But, Luke, the answer is yes, mate. Governments will intervene, whether or they'll talk about intervening before they intervene. But like in New Zealand, and thanks, Luke, and thanks, David, for your questions and your support on the chat today. There it is. The government intervening in New Zealand, taking away tax deductibility for property investors, reducing the loan-to-value ratios. At the end of the day, knowing how the supply chain works, they haven't solved the fundamental thing, which is more developers, more development sites, and more funding at the front end to construct more properties. That's New Zealand's problem. But anyway, I won't go down that rabbit hole, but hopefully that indirectly answered your question, Luke. And the answer both Andy and I do know is yes. Historically, they have intervened, and 99% of the time, in an average way, that has adverse effects, and often doesn't even achieve what they were trying to achieve. It actually often backfires. So, the Australian government tried to do it many years ago, take away negative gearing. The whole supply chains collapsed. Rents went through the roof. Rents doubled it overnight. Stupid idea.
We also have to remember that coming into COVID, and one of the and obviously not for people who are listening here, but financial ambivalence is a pandemic in itself, right? Is that everybody wants an opinion, but nobody's really wanting to focus on it. And obviously, if you're listening here, that's not the case. But God, I just completely lost my train of thought there.
While you capture your train of thought, Andy.
Coming into COVID, geez, I just had a senior moment. I'm not old enough for that. But coming into COVID,
and you're not even drinking, Andy.
No, it's water. Maybe we should get back on the wine. But we need to remember that the government was really trying to prop up the property sector, because before the pandemic hit, they were saying that, you know, as Australia is potentially in trouble and they're trying to stimulate the economy. And the way that they were stimulating the economy was by trying to make sure that the property sector was churning and was going strong. So they were actually pushing the sector and pushing it quite hard, because that was providing a huge amount of the GDP and providing a huge amount of balance, or not balance because it was really one-sided, but it was the growth sector of the economy. And it'd be foolish to believe that just 12 months later, that whole dynamic has changed. So there's got to be a balancing act of kind of going, well, how do we keep construction? How do we keep the property sector going? Because it is such an integral part of our economy, which is the livelihood of all of us and putting money into our pockets. The question will be, how do they do that, but potentially curb, property prices? And my question would then be, well, should they really be intervening?
And that's where they mess it up, right? They don't allow this sort of natural progression to happen. They get in there and they, mess with it, and it shouldn't, it goes in directions it shouldn't. But David, you're dead right, mate. All that will happen is the cost will be passed on to the consumer. Rents will rise in New Zealand to cover the costs of the property market, which is we've seen in Australia, we've seen it in New Zealand. Ultimately, the can gets kicked down the road. Whoever's going to handle the can, unfortunately, it happens. It goes to the pocket of the consumer at the end of the chain. And now, old mate who was, renting his property now has to pay $100 more to rent his property, because the investor can't afford it if they can't, manage it as well. So gang, listen. It's been a good conversation today, Andy. It's gone on for a bit longer than I was thinking. You and I thought, hey, maybe we would have a short one today, but there's even more in this conversation, I think, than we thought. Hey, and I'm completely fascinated by this supply chain conversation that you've brought up, and you alluded maybe we might be able to get somebody on as a bit of a guest in coming weeks too, Andy. So that'd be kind of fun. That'd be awesome.
Indeed. Yeah, it would be one to look forward to, mate, because it's incredible. It's so much a part of our day-to-day life, but it's a beautiful summary as to how this can impact everything. And it really is. I'm looking forward to it, mate. So I'll definitely get them on board.
Perfect. All right. Well, as always, fantastic to sit here and have a chat with you. I always learn something, that's for sure. And I hope everyone got a little bit out of today with the segment. Give us a shout out if you want to suggest anything we might cover. We're always open to a bit of feedback. And next week or the week after, we're going to start bringing on a couple of guests as well. So thanks, everyone. Great to see everyone on today. And thanks for the questions. Thanks, David, Allison, Luke, Tony, Harry, Facebook user, plenty of those. Jeff, Allison. There we go. Riley, good to see all of you guys on today. Anyway, that's it from us. Thank you, sir. And
enjoy the rest of your week.
Yeah. Take care, gang. Join us next Thursday. Wednesday. Wednesday for wealth, water, and wisdom.
That's the one.
All right. See you, Graham. Thanks, mate. All right. See you, Andy. Bye.
See you all. Bye.